Okay, welcome everyone to this special Macro Hive webinar on the crypto Quake, as we're calling it. There's been huge amounts of developments over the past week or so. We've had a depegging in stablecoin. We've also had quite deep correction in broader crypto markets as well. We're bouncing today, so hopefully this is a point of stability. And importantly, what we're trying to do is we're trying to introduce a way, a framework of looking at crypto markets in a time of high level of uncertainty. And one thing I found, and just for introduction, my name is Bilal Hafeez. I'm the CEO of and head of research of Macro Hive. And what we do at Macro Hive is we provide high quality research for investors, whether they're individual investors or institutional investors. And one of the things that we like to stand out on compared to other people in the crypto space is we have a framework. We're very disciplined. And we try to be as objective as possible when we look at crypto. And when I survey the crypto space, there's essentially three camps in crypto. There's the real skeptics. So there's all these voices, often with people who aren't involved in crypto, who basically think crypto is a waste of time and nobody should touch it. So you have the big negative people. Then you have the original believers who were in crypto early on, who basically have a very kind of maximalist perspective on crypto, thinking that crypto is going to change the world and you need to displace the old system. And then you have the recent converts of people who are initially skeptical, who have converted, and like religious zealots, they also become big evangelists for crypto and think that crypto offers risk-return characteristics as an investor that you can't get anywhere else. My take is that one needs to have a balanced view on crypto, that it's an important technology. We do believe in it in some form. A lot of it is perhaps a waste of time, but you aren't quite sure which part of crypto is going to survive or not. And also, we like to look at crypto as an asset like any other asset. So just like we look at gold, or you can look at artwork, or you could look at land, or you look at equities, crypto is another asset. And we look at that crypto as an asset class, and then how does it behave relative to other assets? And so then you can make a more informed decision. And because of this has allowed us, for example, to tell our listeners and readers to not allocate 100% of their wealth to crypto, which many other evangelists for this space have told them to do. And we've seen recently that that was not a good idea. A key thing here is that the volatility of crypto is very, very high. So you need to adjust your position sizing to make sure that you don't lose all of your wealth. And having been in markets for 20, 25 years and having regularly advised and continue to advise some of the leading hedge funds in the world and top investors, one thing I found with almost all investors is that the number one rule they always follow is that don't get wiped out. You always have to size your position so that there's no chance that your survival, your financial security survival is at stake. And that's an important lesson, hopefully, that we should also take from what we've seen over the past week or so. Now, the other thing I should also add is that I also fortunately have Oksana Grinchak on the call, on the webinar here with me as well. She used to be in traditional markets at Goldman's and Barclays and BNP and so on. And now she's at the Amber Group, which is deeply involved in crypto, which you can perhaps mention when she comes on the call. And the structure of this webinar is that I'll be giving a context for crypto and stable coins of what we've seen. Then I'll hand over to Oksana to give, who will give kind of more of in the weeds perspective on some of the developments we've seen in crypto over the past week, with a particular focus on the Terra dollar, on the stablecoin unwinds that we've seen. And the reason I want to introduce some kind of context or principles is that when markets are highly unstable, you kind of need to hold on to something to understand how you can navigate a tumultuous sort of period in markets. Otherwise, you'll just be bouncing from day to day and just responding to price action and getting emotionally quite unstable if you sort of just do that. And I also want to situate crypto in broader historical context in terms of technology. So let's jump in. I prepared a few slides as well. And let me just share the webinar. And so What I kind of wanted to do was to almost sort of set out some sort of principles and then map them back to crypto. And what we're seeing over the past week or two. The first principle I like to sort of put out is that you can have a revolutionary technology, but it doesn't necessarily mean that that tech or the equity or the assets associated with that tech will necessarily make you rich. So, for example, the internet has clearly changed the world. Yet, if you look at valuations of tech, if we go back to the 1990s bubble, so this is the performance of tech relative to boring small cap companies, so NASDAQ versus the Russell, you see that, during the late 1990s, the valuation of tech went crazy. So there was all of these new possibilities and frontiers were opening up because of the invention of the internet and the commercialization of the internet. So people thought that there'll be this new future. But in the end, the valuation that the market attached to those possibilities were way, way too high. And you ended up having this huge crash. And it took, up until it took about 10 years, for tech to start to outperform the rest of the market again. But over this period of time, tech did change the world, So, during the 2000s, 2005, 6, 7, 8, that's when iPhone was launched, Facebook was launched. So some of the things that really changed the world all kind of happened after the dot-com crash. But the point here is that crypto could well be a revolutionary technology, could change the world, but it doesn't necessarily mean that crypto prices should always go up all the time. You could still have a huge crash, yet blockchain, decentralized concepts could remain with us and become part of the infrastructure of the world, just like the internet was, and just like the dot-com crash happened. What happens in price doesn't necessarily tell you what's going to happen in the adoption of that technology. And if we go back to the dot-com period, what we found was, and this is in the kind of the chart here shows you a bunch of the big tech names in the 1990s. So you had Amazon, which is kind of held up as the example of the top tech company. But in the 1990s, before the dot-com crash, you had Netscape, At Home, Excite, VeriSign, eBay, Yahoo, all of these companies that were held up as the next big thing, just like you have Ethereum today, you have Bitcoin, you have Solana, Cardano, all of these different L1 technologies and crypto. And then what happened to those markets? Many of them just went bankrupt and nothing happened. Only one of them, Amazon, broke out and had delivered huge amounts of value. But others who are still around, like eBay, Yahoo's kind of, still around in some form, they basically weren't able to deliver the value that Amazon was able to deliver. So this tells you that in the early stage of a new technology, you get huge amounts of new companies, and many of them just die. And then perhaps one is the breakout one. But even the breakout one, so if you look at Amazon, during the dot-com crash, Amazon fell 94% during the dot-com crash. So if you had bought at the highs of over 100, you would have been pretty much wiped out. And it took 10 years for the price to go back to the 2000 peak. So that's how long it took for a very successful company like Amazon. So it would have been better to have not bought Amazon during the dot-com period and to have bought it after the crash, or even to have bought it in 2007. That would have been the point where you really had takeoff in Amazon. So again, this kind of goes back to this idea of revolutionary companies, revolutionary tech. The way prices behave is different from will the technology deliver value or not. So that's kind of one of the principles I wanted to kind of lay out, this idea that even if prices are falling or going up, that doesn't tell you whether that technology is revolutionary or not. Or will it be a lasting technology? The second principle is what I call the AntiMckaffs Law idea, which is that there's this common thing in crypto circles for the evangelists to say that crypto will have super high valuations because of a network effect, like Facebook. The more users you have, you get exponential combinations of those users, which then ends up meaning that if you have 100 users and you jump to 200 users, you don't just double in the value of your network, you actually quadruple or it goes exponential because you have so many more ways people can interact. So the value of the network is kind of exponential, whereas the number of user growth is linear. And so you end up with much more value with the more users you have. Now, the issue with that is that you could also argue the other way around, which is that the more people get involved in a space, the market becomes more efficient and there's less price gains. So the time to get into a market where you get the biggest gains is when there's less people involved in it, where there's a possibility later on of more people getting involved. And that's precisely the case with Bitcoin. So this chart on the left here shows you the number of wallets that I held at blockchain.com, holding various different crypto, but mainly Bitcoin. And what you find is when the biggest gains in Bitcoin happened when there was a small number of wallets. And the same thing is if you look at addresses, active addresses in Bitcoin. And what you find again is when there was a smaller number of active users, that was when you had the biggest gains. You were getting 500% gains on a 3-month basis or 2000% gains. The more users we've got in the crypto world, kind of the returns are getting smaller and smaller and smaller. So it's kind of a maturing market. You have more users involved, but actually the price gains are getting smaller. So for all the people that talk about Metcalfe's law is the thing that's going to lead to higher valuations and bigger gains, the data tells you the opposite, that the more people are getting involved, the more priced in it's becoming, and the gains will start to become more like what you see in equities, the more sort of mature markets. And people in markets know this, frontier markets, when new markets gets launched, that's where the big bucks are. When it matures, when mom and pop are trading it, when everybody's trading it, then it's not so interesting. And so this is one idea I kind of wanted to tell people, make people aware of, this understanding of more people getting involved doesn't necessarily mean you're going to see big price gains. And the third principle is that low interest rates are great for tech companies, because the issue with lots of tech companies are there's a huge amount of investments required. It means you lose lots of money. And you scale by basically finding all sorts of clever ways to get more users onto your platform. But the cost of acquisition of getting those new users into your ecosystem is very expensive. So you're burning money, you're losing money, and with a promise of revenue in some distant future. So you're burning huge amounts of cash to acquire all of these people into your ecosystem, your layer 1 or whatever. Or your stablecoin, your DeFi exchange. And the promise is in the future sometime, you're going to get those revenues. Now, if you're in a zero interest rate environment, a very low interest rate environment, then the market basically says it doesn't matter if it's in the future because interest rates are low. So the discount rate is such that the future, the returns in the future are the same as the returns today. We can bring them forward very easily. And so that really helps tech stocks. And an example of that is, if you look at the history of NASDAQ, so this is NASDAQ since the global financial crisis, the Fed cut rates to 0 or 1 after the GFC period, and really tech stocks did super, super well over that period of time. Then the Fed ended up hiking in 2016, 2018, and there was a period of consolidation, and now the Fed's hiking again. And lo and behold, tech stocks are starting to suffer. And if we look at how that compares to Bitcoin, so we know that the correlation between Bitcoin and NASDAQ is very high. So this orange line here shows you the correlation. It's a bit unstable, but generally speaking, there's a positive correlation between Bitcoin and NASDAQ. But when interest rates have been going up, so this blue line are 2-year US interest rates, which capture expectations of the Fed raising rates. As soon as the Fed started to raise rates, what's happening is that all the assets in the world that were linked to easy money or free money suddenly become correlated. And that's what you're seeing now. And so the correlation has surged between NASDAQ and Bitcoin, essentially, as when you start to change your liquidity regime, everything that has touched by that liquidity becomes correlated and remains highly correlated. And that's the environment we're in right now. So the underlying driver of this correlation, in my view, is higher rates. We're moving from low rates to high rates. Correlation sort of shoots up. So essentially, crypto is a play on tech, which in turn is a play on rates. And that's kind of what's happening right now. Now, as you can see from this chart, the correlation is unstable between tech and Bitcoin. So that will change in the future. It won't always be the case. But we're in this transition phase in this regime where the correlation is shooting up. And so in an environment where the Fed's raising rates, which we think they'll continue to do this year, that means this correlation is going to remain high. And this is a quite tough environment for crypto in that context. So you have to keep an eye on NASDAQ tech. Is that weakening? That probably means crypto will weaken as well, and vice versa. So that's the third principle. Interest rates matter, low interest rates are good, high interest rates are bad. The final point or principle I wanted to mention is that all pegs break. And my roots are in currencies. So I actually started my career in 1997, which was during the Asia currency crisis. So I was actually building models, which I'll talk more about in a moment, around that all. So I've got a deep affinity with currencies. But just for context, what we know in nature, what we know in life, what we know in kind of any system, especially ones that involve human constructs, nothing holds forever. Everything breaks. And so, for example, going back historically, if we look at the pound, it was part of the gold standard. It was linked to gold in the 1800s. And then in the 1930s, that peg broke. The First World War happened. UK tried to hold on to its peg. It basically destroyed the UK economy. And so in the end, the pound had to break away from the gold standard. Similarly, in the US, after the war, the US dollar was pegged to gold. And then by the 70s, that peg broke. The US basically went off the gold peg and introduced the end of the Bretton Woods era, and you ended up having free floating currency. So this is dollar to gold. It was fixed, and then suddenly, boom, in the 70s, it broke. You had a break in the peg. And importantly, Fed hikes are often a big trigger for pegs to break. So as I was saying earlier, 90s was where I kind of grew up. But in 1994, the Fed hiked aggressively. So the economy was doing well, there was some inflationary pressures, and then suddenly the Fed just hiked like crazy in 1994. And they hiked more than people thought. They hiked 75 basis points, which people are sort of speculating about now. And then what happened? And you have to remember, in the early 90s, many countries, especially emerging markets, were pegged to the dollar because they had an inflation problem in the 70s and 80s. So then they pegged themselves to the dollar to establish credibility. So you tie yourself to something that gives you credibility and stability, so that you can manage expectations in your own economy. But what happened? In 1994, the Fed hiked, and then the first peg went, which was dollar Mexico, which was called the tequila crisis. So that was a peg that collapsed. So Mexican, it devalued by like 50, 100% or so. Then that was the first devaluation. Then you had the next devaluation, which was 1997. All the Asian pegs broke. So dollar Thai baht, Thailand was the first one that broke, then dollar Korea, then dollar Malaysia. And this was the time I was introduced to markets, and I was building models to try to predict devaluations in markets. And the funny thing I found with the models I built was the single best predictor of whether a currency peg would go was there another currency peg that had already depegged in the recent past. So all the modeling on credit, this, that, balance of payments, that didn't tell you anything. What did tell you is as soon as one peg goes, it leaves a cascade of other pegs. And that, I think, is quite telling for the environment we're in today with stable coins, which I'll come to in a moment. So 97, so remember, the Fed hiked in 94. Mexico broke then. 97, a couple of years later, all the Asia pegs broke. Then 98, the ruble peg broke, which blew up LTCM, this hedge fund that had kind of leveraged up massively on assuming that the ruble peg would hold. Then in 1999, the Brazil peg broke. And then a couple of years later, Argentina, which had an even stronger form of a peg, what's called a currency board, where essentially you turn kind of in effect into law that you have to keep your peg in place, that broke as well in 2002. So this tells you that no peg will ever last forever. Some pegs could last for decades, but in the end, they all eventually break. So nothing's indestructible in that sense. What we know from the 90s experience is that one trigger for depegging is hikes by the core central bank, which in this case is the Fed. So when the Fed hikes, pegs everywhere start to break. And I think that's what we're seeing today. And not only in crypto, but if we look at one peg, we have dollar Hong Kong. That's a peg that's also starting to test the upper bound of its range. So that's something to watch. Dollar China, which is not formally pegged, but this blue line here shows you dollar China inverted. So if the line's going down, that means the Chinese renminbi is weakening. But that collapsed 4 or 5 weeks ago. And that was before the blow up in Terra. But what this is telling you is the FX markets were telling you that pegs everywhere are coming under pressure. So then if you move over to stablecoin, then you see obviously Terra has completely sort of blown up. Actually, this chart is a bit old because if you updated this now, it'd be much lower, the price point there. But the main points here are that, there's a few sort of principles here. The movement to price doesn't tell you whether the technology will be with us in the future. So my view is that crypto in some form or another is with us. It's part of the architecture of the world going forward. What we also know about technology is that a lot of stuff that's around today will be wiped out. We aren't quite sure who will be the winners or not. So that's principle number one. Number two is that this idea that the more users you have, the bigger price gains you have. That's not necessarily true. Often it's the case that means the market's maturing, which means that the price returns will start to become closer to what you're seeing in other more mature markets. Third is that interest rates matter. Low interest rates are great for tech, crypto, and everything. High interest rates are bad, and we're in that environment right now. So my bias on crypto right now is to be very defensive, so neutral to bearish to negative, to kind of just staying away from crypto in terms of having a net long position. I have the same view on equities as well. I want to be short equities or just stay on the sidelines, be in cash. And it's just better to wait this out and then buy at more distressed prices later on. And then the fourth one's on pegs. The rise in rates causes huge amounts of stress on any pegs. And stablecoin, not only does it have the tech component, which is under pressure anyway, but it also has the peg component. So I'd be very kind of cautious around the stablecoin space right now. But there is some nuance here as well in stablecoins, the different types of stablecoins, and it's easy to paint them all with the same brush. There's algorithmic stablecoins and there's collateralized stablecoins and so on. But to go into the minutiae a bit, I'll hand it over now to Oksana, who can talk a bit more about the view from the trenches, so to speak.
Thank you, Bilal. Hi, everybody. Thank you for inviting. And I guess I'm sort of going to be doing something opposite. You give a big picture overview, and I'm zooming in on a very kind of most recent few weeks or a couple of months. So we've had a few super exciting events in the stablecoin space and impacting the crypto markets in general. And I will take just a couple of minutes to stop for a second and just look at the purpose of stablecoins themselves. They are so there are different ways to get on blockchain, and in fact, you probably don't need fiat money to own Bitcoin, right? You could, download computer code and run a node, get yourself an address, and wait for someone to send you some Bitcoin. But it's a very complex and kind of annoying way to do it. So over time, the community or the people who started using crypto assets for payments and whole universe of different contracts and utilities, they've kind of narrowed down to two goals or two purposes of that stablecoins serve. One is an easy way to get from fiat into digital space, and the second one is to be able to park, quote, quote, your money in digital space for a period of time, and also have a digital coin that is comparable to the fiat space that could be a denomination for a whole universe of other cryptocurrencies. So on rail part is a little bit, well, I guess both of these propositions are extremely valuable. And I think especially the one where, for example, you have exposure to crypto assets, you benefited from some asset appreciation, and instead of selling your Bitcoin and on an exchange or wherever you trade and getting it back into fiat, which takes a lot of transaction cost for customer, only to get back into it a month later. You want an opportunity to kind of remain in digital space but not lose value. So in a sense, you're effectively trying to immunize from volatility of crypto assets, which, this is where I'm going. Volatility is a very precious asset. So this value proposition is actually very, very valuable in our space. And it's no surprise that, and it's being delivered at the moment in two ways. There are centralized companies who do that, and all the kind of known names such as Circle and Tether, which we will come back to, and so forth, where one unit of digital asset is backed either by one unit of fiat or gold, or there are different varieties. And there's an actual company with actual people, board and CEO and so forth behind it. So it's a completely centralized finance offering. And it's no surprise that crypto people try to find a decentralized solution to exactly the same problem, which I think it's the beauty of this technology, that not just the payment system, not just the finance, but this connection to fiat. So how's it done? I will try to be very, very brief, but there's a universe of these decentralized stable coins that create the peg that Bilal was just talking about, and they try to do it programmatically. So they try to create a computer code that is supposed to maintain a peg. One of the older ones is DAI, for example. And what's true about both decentralized finance, so lending and borrowing in crypto space, as well as stable coins, decentralized space, stable coins, when you put the trust in the computer code, the way you can really only implement it is in an over collateralized way. Because ultimately you cannot put a computer code in jail, but you can put a human person in jail, or a company. So DAI, being one of the, by MakerDAO, is one example. It's actually performed relatively well in terms of maintaining the peg, but it is quite heavily over collateralized, which effectively creates, it's expensive or creates a certain inefficiency. And I think at this moment we probably have about a good dozen of decentralized stable coins. Some are more common or popular, others less so, but I will stop for a second on Terra, which is obviously what's at the top of everyone's mind. So what's different about Terra? Terra Luna, first of all, it's a layer one blockchain. It's actually written, I think, on Cosmos, but this is different from DAI, which is built on Ethereum, as well as the centralized ones, Circle and Tether, they're all built on Ethereum. So Terra Luna, it's a layer one, it has its own coin called Luna, and the price of Luna can go up and down just like any crypto asset in our universe. So the founders of the blockchain decided that they also wanted to provide their own stable coin. I suppose the motivation is that you want to keep your market share, right? You want to keep your users. So if somebody used Luna, was long Luna, wants to get out, they don't want them to move away, they won't continue to use the blockchain, because at the end of the day, you get pay the transaction fees. So, I mean, that's what my thinking would be. So we can maybe invite one of those and see what, what they're thinking. But so they created a stable coin that they tried to peg to US dollar in the following way. And if I can take 1 minute to explain the mechanics, it's not that complicated, but I guess it's exactly what happened in the last few months. And the idea here is that the stable coin called Terra Luna should more or less be equal to the amount of Luna that is valued at $1, for example, US dollar, although there were other currencies that it was pegged to. How does it work? If the stable coin Terra Luna, it trades, say, at 1.1, so 10% higher than the peg. And by trades, I mean trades on, I don't know, Binance, FTX, or on some decentralized exchanges and somewhere else. But if you go to Terra Luna blockchain, they will always exchange one Terra Luna for whatever, how many Lunas it takes that it's equal in dollar value. So what can I do? I can buy Luna worth of dollar, go to Terra blockchain, exchange it for Terra stablecoin worth of dollar, and go back to FTX or Binance or whatever it is and sell it for 1.1. And I pocket the 10-cent difference. Now, when I brought them the Luna that I bought, what do they do with it? They burn it. It's gone. And by they, I mean the computer code. It's not actually a human person. The computer code is programmable to burn the Luna and issue a stable Terra Luna stablecoin for you. So far, so good. What happens on the way down? Suppose that the stablecoin is trading at 90 cents on some exchange. What do I do? Well, I go to the exchange, FTX, Binance, whatever. I spend 90 cents to buy one stable coin, go back to Terra blockchain and ask them for the equivalent amount of Luna for $1. They give me the Luna. Where do they get it? Well, they mint it. The computer code mints it. So we already see an increasing inflation rate. I take the $1 worth of Luna and go back and sell it in the market, but I spend 90 cents to start with. However, so I get $1 worth of Luna, and I guess this is the key question. Do I spend it? Do I cash it in? Do I sell it straight away, or do I hold it? And I think there's a clear incentive to lock in the profit, right? So when the Luna is printed or minted by the computer code of the blockchain, in this situation of being below peg, there's an incentive to sell the Luna. So I hope I kind of explained it in a decent way, that there is a clear asymmetry when the Luna is burned on the way up versus the inflation rate on the way down, and the incentive to keep print and sell Luna as the price collapses. So this is the mechanism that was put together. It was pretty clear to everyone involved in it, and but you don't fix what ain't broken because the price.
So when you say, sorry, Oksana, just to be clear, so what you're identifying there's asymmetry, which is that the program is such that if stablecoins misaligned, then you can receive some Luna or pay some Luna. But if Terra is below, UST is below $1, Luna has to issue more. You know, it kind of creates this money supply. They're printing money to try to give you something, and that's kind of a bad dynamic, because you're basically doing something that could lead to a lower Luna price, which is
there's an unlimited
Terra.
inflation, an unlimited inflation rate that there's not even a human person to stop it unless you break the code, where the computer code is basically printing Luna, and the market participants are incentivized to actually take advantage of it and sell it straight away. So chances are they're not going to keep it in their wallets. You want to lock in your free money, your arbitrage money. So there's that negative dynamic there. So, but if Luna price is going up for whatever the reasons, and we'll come back for a second, then you may choose not to sell it, right? Then, you know, if there are utilities, there is a reason to hold Luna. And that's exactly what's been happening. So Luna has...
And just on that point, so your point about the asymmetry there was that people in the crypto space were aware of this. So many people in crypto land were aware that Luna and Terra were basically vulnerable. You know, it's not necessarily, obviously the exact timing is a surprise, you don't know which day, but in stablecoin circles, so to speak, everyone was aware that this is
well, you read the white paper, and it's not,
it was obvious. It was clear that it was not built to last, so to speak.
Yeah. However, it hasn't materialized the negative sort of like market dynamic, because Luna as the layer 1 protocol had quite a few legitimate users and a few utilities. It had 2 most popular contracts on it, Miro and Anchor. And Miro was a way to use Luna to kind of trade other coins in almost like ETFs. In a fractional way. You can get exposure to Ethereum or some other coin with Luna, which was kind of interesting. But let's leave it aside. And then the lending and borrowing protocol Anchor, which again, for a while it had quite reasonable rates and nobody looked at it as a Ponzi scheme to start with. But let's fast forward to, say, beginning of this year, where, and again, Anchor protocol is like a digitalized middleman between lenders and borrowers, right? So, and somewhere in January of this year, Anchor protocol started offering something like 19.5, 20% to lenders to attract deposits. And the borrowers were charged something around 10%. But also it was an over-collateralized borrowing was, I believe it was something like 50% LTV. So there's a bit of a mismatch already. Of course, you could stake Luna, which staking yields varied, but maybe even like up to 8%. But there's still, I don't want to get into too much sort of plumbing of that, but one way or another, the 20% yields were definitely subsidized. Now, this is where I would not want to be a regulator looking back into this situation, because incentivized yields, is that a bad thing? I mean, of course, if you've looked at DeFi, this is a very common phenomena, but we have sales, we have teaser rates on mortgages and so forth. You're attracting capital, and if there is a value proposition behind it, it's probably not a bad thing to provide certain incentives. The point is that look at the business model behind it and see if it's sustainable and affordable. And at the end of March, first thing that happened was that price of Luna crossed $100 at the time, but Anchor protocol came out and said, by the way, guys, 19.5% used to be fixed, but now we're still holding it at 19.5, but it will be flexible. So this was your first sign that at some point these rates will obviously go down. And being aware of this negative market dynamic and embedded in the pegging sort of mechanism, the founders of Terra Luna come out and tell you exactly what they're supposed to do, how they're going to address it, which is create a reserve to support the stable coin with something that actually has a limited inflation rate or negative inflation rate. So they told everybody they were going to build a reserve of Bitcoin. They said how much. They were going to get up to 10 billion. They started buying it. The process of buying was very transparent and very visible to the market. Now, I don't think that was the only flow that pushed Bitcoin price to this recent 46K. I think we had a bit of a risk rally, a bit of a risk relief post-Fed. So a lot of other things got aligned in that point. A few technicals levels got broken. But anyway, they bought it at the local top around 46. And exactly in the same way, April, it's hard to blame everything that happened in April on everything that was happening around Terra. I mean, we had a pretty difficult April month for stocks, for NASDAQ, for tech, and so forth, and crypto sold off. And this very widely publicized reserve of Terra, I mean, it's in market's nature to, if there is a vulnerability, and especially when it's known to I'm sorry about.
And just to while you're dealing with the notifications, I mean, so my understanding then, what we have here is a coin with badly written rules that was very vulnerable to an attack, especially if the price of Luna, which is the reserve it was linked to, was going to start to fall in value. Then paradoxically, although it's a decentralized network, you then had a centralized actor come in, to introduce a reserve. So in effect, it's like a central bank or the Fed coming in to bail out the stable coin. So there's kind of parallels to the global financial crisis. So that's kind of the dynamic that we're kind of in the midst of right now. Is the intervention, going to be enough to stabilize the coin? Now, one question I have is, okay, it seems like nobody really will expect Terra to do too well going forward. The question is the other algorithmic coins, like DAI you mentioned, what's the difference with their rules? Why would they be more stable, so to speak, than Terra? What's the differentiation in the algorithmic kind of world?
I think the big difference is, it would take another webinar to explain how DAO and DAI works. But what I mentioned in the beginning, DAI is much more over collateralized, and from the beginning, from the design, it's collateral is Bitcoin and Ethereum, and the stablecoin itself is actually written on Ethereum. So it's not the native layer one, which uses its own native coin as a stabilizing mechanism, which is not very stabilizing. What's interesting is, like I said in the beginning, there is also a very strong argument. If I have my own layer one blockchain, I would really like to have my own stable coin. I really want to keep my market share, and I want to have my own stable coin. And we've seen this happening recently. We've had Tron and Near and a few other layer ones trying to do the same. So it's very interesting to see what development, how they're going to design it, because clearly this was actual events. I'm sure we'll see a Netflix documentary of what happened, and I don't want to get into conspiracy theories and start digesting exactly who did what. But in general, I think it's an extremely interesting example and a kind of milestone, a stepping stone in how decentralized coins will be built. And I hope they don't get banned completely. The idea being is that pegging itself, but I mean, it's a special case. I think markets in general are susceptible to negative equilibrium behavior, right? So it's the information asymmetry, it's the risk controls and so forth. And in traditional finance, the best thing we've come up to deal with that is the buyer or seller of last resort. That has not been used in decentralized stable coins yet. So, and I think it's kind of what they might have tried to do with Bitcoin, just given that ultimately there is a limited supply. However, there are a lot of value destruction that can happen before we get there. However, the bigger picture is that if you're trying to build an insurance against this negative dynamic, it's like you don't want to, if you want to protect against the fire, you don't want to keep buckets of water in your house, you want to build sprinklers. So it will be interesting to see I'm not smart enough to come up with how this is supposed to work, but I do hope.
And one question we're getting from audience there, just on this point is there some kind of mechanism for contagion to occur here?
Yes.
Like is there something within what's happened that will naturally lead to contagion?
Yeah, well, there are two answers here. The first one is that we had over 40 billion kind of value wiped out just through Terra, which is not a trivial number. It's not existential for cryptocurrencies in general. I don't believe Terra collapse on its own will wipe off crypto as an asset class, not that. However, there is a digestion process that is still to take place. So there's been a lot of exposure from both retail and institutional clients. Some people, especially in Asia, have used Terra as a store value mechanism, but also institutional clients who have exposure. So there is then the question is what else people have on their books, what else they're going to do. And there's been a short-term. Sorry.
Someone really wants to get in touch with you.
Something going, like I'm wearing headphones. I'm not sure why. But there's been a very short dynamic where people were taking money out of Luna during the crisis and actually putting it into Bitcoin and Ethereum. So there was a temporary actually support for the majors. However, the bigger question is where, we have that big exposure in the market and so forth. So that is still needs to be digested, but I do not believe that will take that Terra on its own will take crypto down. Now the question is, and of course that's been the theme in the market for the last couple of days, would other coins come under attack? I don't think other stable coins will come under attack because, like I said, this is a special case in terms of how it was built. But as we saw, there was a lot of sort of speculation about Tether and it's been under a lot of scrutiny and under a lot of under radar for a long time. So far it's surviving, but again, we are in a classic market dynamic where if there is a real or perceived vulnerability, it will get tested. The question is, what's behind it. And again, Tether is the largest stablecoin in the market. It's about 80 billion. It's the oldest, probably, stablecoin in the market, present on most exchanges. From the client side, being sort of a user of Tether, most clients have nothing to complain about, meaning they're extremely professional, diligent. They never lend Tether uncollateralized, unsecured. The bigger question is what they've got in their reserves, and that's been discussed in the media for a long time, to the point that they are the only stable coin, as far as I know, who actually they were under pressure to hire accountants to go through their book and report that they have enough, they're solvent. I mean, it didn't say anything about liquidity. And like we mentioned, and I think you have a little slide about Tether, that's what they showed us, that 70-75% is currently in liquid assets, although that includes commercial paper. But I guess this also brings a question of, what I think will happen, these events will fast forward any kind of stablecoin regulation from different jurisdictions. So not just in the US, but...
we actually got some questions coming in, actually. So if people have questions, post them in the pro chat room. But one person's asking, it's a good question. What is any lessons to draw from the Terra blockchain halting the blockchain for a period of time? Can we understand there were not many participants taking part in the validation process? The price has gone so low. Can someone afford to buy enough tokens to hijack a whole ecosystem? I mean, is there something about the way the blockchain was halted, tells us something broader about the crypto world?
I guess, my understanding that, again, the halting of the blockchain was Terra specific. If this were repeated on another coin, which again, Tether would be completely example because it's a centralized and they've been honoring all the redemptions. Here, in fact, it's correct that a lot of the blockchain was halted as they're using also an Oracle coin that is supposed to send the information of the difference in prices, and it was not working at the time. So a lot of pricing that was taking place, a lot of selling of USD actually took place on exchanges, including decentralized exchanges on Curve. So that I mean, to answer the question, my response would be it's extremely Terra specific,
yeah. Okay. No, that makes sense. Yeah. So for now, it's a particular case here, and the key thing will be if this happens on another blockchain. Another question was around sort of Tether. They refused to disclose details on $40 billion of bonds because they were worried about revealing some kind of corporate secret, so to speak. So there's a balance always between you want to be open, but at the same time you're a business and you have your own proprietary information. Is it not a problem not knowing who Tether helps finance in the companies in a commercial paper? So this person saying like it's like the money market funds before the global financial crisis. You're in the fund, you weren't really quite sure what was in it, and then in the end it was revealed what was in there. So what's your kind of thoughts about the transparency side?
Well, we have an extreme opposite example of that. Terra Luna itself, they told you exactly what they were buying, when they were buying, and look how it backfired. So if I were running Tether, I would be very careful about it, disclosing, what exactly is in the book. Also, if you take any bank, traditional commercial bank, I imagine there's not a single bank in the world that would honor deposits within a day if everybody showed up, and it's part of their business to build a loan book and have certain portion of liquid assets. I guess this is a very tricky question that will be left for the regulators, and we will see what the answer is. But I can see the point of, or at least the reluctance of disclosing exactly what's in your reserves, because you don't want to.
Actually, you make a good point about the transparency, because I mean, for me, as someone who's grown up in the traditional finances, the blockchain is so transparent and the algorithms are so clear that it's like almost like a treasure trove. If you're like a traditional finance guy, you look at it and exactly the weak points where you could arbitrage or launch a speculative attack against the system. So I think the paradox with in the crypto space is that if the rules set up within the systems are not set up well, they'll be recognized very quickly and they'll be destabilized very quickly. I think that's, for me, I think to some extent what's happening in the last year or two is a lot of traditional finance expertise has come into crypto, and then suddenly you get this expertise in finance coming in, and that gives an additional recognition of inefficiencies in the system, whereas before it was more engineers and technologists who were looking more for operational inefficiencies, whereas I think financiers kind of look at incentive inefficiencies to some extent. And so this is an interesting kind of period now.
Yeah, although on that point, which is a slight digression, but it's incredibly interesting that there's so much information on chain. However, as the product becomes most institutionalized and there are more derivative products and more structured products and ETFs and funds and so forth, the informational contribution, I don't want to say that on-chain analysis becomes less relevant. It is, but it's becoming one component out of many. So its informational contribution is maybe slightly declining. And
no, that's what we're finding. I mean, we do regular research on Bitcoin, Ethereum, and so on, and we do a lot of on-chain analysis, and we've crunched the numbers and everything. There's a certain value in it, but it's not a huge amount. There's lots of other factors.
But it used to be.
It used to be a lot, but I think macro right now is like the dominant factor to some extent, and that kind of gives you most of the direction there. Now we only have a minute or two left, so we'll kind of wrap up soon. But in terms of if you're in our audience, if you're somebody who's holding some set of crypto coins, Bitcoin, Ethereum, or Gala or whatever, some of the other ones, and then also you have some stable coins. I mean, in this sort of environment, how worried are you in terms of the asset class of crypto? Given everything that we've seen so far.
I think this is a very obviously it's a vulnerable place for crypto because we are on some very key technical levels. And again, speaking of on-chain, we're also, very close to sort of on-chain realized price, realized market cap values, and so forth. However, and I was just speaking to our head trader yesterday as well, and that was his opinion as well. We actually think that crypto is much more vulnerable to macro as the other way around.
Okay.
And even if we see, 80 billion Tether attack is a huge deal, and I think it could have massive repercussions, and but macro impacts crypto a lot more at this juncture than crypto impacts macro. So my feeling is that keep your powder dry, that there will be a lot of great opportunities. I would probably be careful with Luna right now, because some people looking at it as, it's basically trading at zero, and but I think there are a lot of better trades at the moment. Yes, there is a sort of macro backdrop that we need to still go through and have a few asset prices adjusted, and
I'd agree with that. I mean, when we've looked at everything, what we've worked out is the best thing that could help crypto right now is not some kind of change in protocols or something there. The best thing for crypto right now would be if the Fed said they're not going to raise rates anymore. I think something like that would turbocharge. So for me, that's the swing variable here is much more the Fed's policy that swamps every other factor. So points well taken.
But that said, and this is maybe a little bit of a cliche because it's been discussed a lot, but I still think that Ethereum merge is undervalued. It's not in the price, and again, part of the macro factors. So if you're quite bullish on that, there are also a lot of interesting opportunities there. And also this last move, it's interesting that some people took it as, it's going to wipe off everybody and we're going to go back to the real ones, Bitcoin and Ethereum. And the other ones actually really looking for interesting, what I would call major miners, meaning like very bigger market cap, sort of layer one.
The next rung down, the more solid ones in the next rung down, away from the Bitcoin Ethereum.
Which I think also is
okay. Well, I'm cognizant of time. We tried to stick to time here. So Oksana, thanks a lot. It was excellent for your contribution here. Hopefully this has been helpful to our audience. It was an impromptu webinar. We weren't expecting to do this, so hopefully apologies if there was some logistical issues here, but just good luck with your investments and everything. On Macro Hive, we're regularly publishing stuff on crypto, so if you just go to macrohive.com, you can see everything we're producing, and reach out to myself or Oksana if you want to have sort of bilateral conversations. So with that, thanks a lot everybody, and good luck.